The vault is almost empty, and the bank that emptied it is the same bank that sets the price. JP Morgan just took delivery of silver that the COMEX barely had left to give. They did not buy a futures contract and roll it forward like everyone else. They showed up with a truck and said, "Hand me the bars." And they have been doing this for months. Exposed. That is the word that describes your financial position right now if you are holding paper silver. If you own an ETF that says silver on the label, or if you are trusting that the price on your screen reflects something real sitting in a vault. Because JP Morgan now controls 750 million ounces of physical silver. That is more than 7 times the total amount of registered metal available for delivery on the entire COMEX exchange. The place where the world supposedly discovers the price of silver has roughly 103 million ounces left. JP Morgan alone holds 7 times that. They are not just playing the game anymore. They own the board, the pieces, and the rulebook. And if you do not understand what they are doing right now, you are going to be the last person standing when the music stops. In the first week of January 2026, JP Morgan issued delivery notices for 99% of 8.1 million ounces of silver on the COMEX. They were the seller handing over the metal. That sounds normal until you look at the other side of the trade. The buyers who received those deliveries did not leave. They did not close their positions and walk away. Instead, open interest in the January contract actually increased by over 1,400 contracts on the same day. That means new buyers were flooding in, demanding immediate physical delivery, faster than the old orders could be filled. Think about what that means. The line at the silver vault is getting longer, not shorter. People are not rolling their contracts forward into the future like they always used to. They are rolling backward. They are pulling delivery dates closer. They want the metal now. Not in March, not in June, right now. That is the opposite of how this market has functioned for 50 years. And it is the clearest signal that something underneath the surface has fundamentally broken. I track these fractures in real time, so you see the crack before the ice gives way. Hit that subscribe button right now. I read every single comment to understand how real people are navigating this economy. Drop yours below. Are you holding physical silver or paper? Also, a quick shout out to my partner channel Finance Unfold. Go follow them as we build a community of investors who refuse to be caught off guard. Now let me show you the blueprint of the crisis. To understand why JP Morgan is hoarding silver like a dragon sitting on gold, you need to understand the machine they helped build and why that machine is breaking apart. The COMEX is the commodity exchange in New York. It is part of the CME Group. For decades, it has been the place where the global price of silver is determined. But here is the dirty secret that Wall Street does not advertise. The COMEX does not actually trade silver. It trades promises of silver. These are called futures contracts. Each contract represents 5,000 ounces of silver. A trader can buy or sell these contracts without ever touching a single bar. Most of them never intend to. They settle in cash. They roll the contracts forward. The physical metal just sits in the vault collecting dust while billions of dollars in paper bets fly back and forth above it. This system works perfectly as long as one critical assumption holds. Nobody asks for the actual metal all at once. It is the same assumption that keeps your bank alive. Your bank does not have everyone's money sitting in a vault. They lent most of it out. As long as everyone does not show up on the same day demanding their cash, the illusion of solvency holds. But the moment confidence breaks, the moment depositors form a line around the block, the bank collapses under the weight of promises it cannot keep. That is exactly what is beginning to happen to the COMEX. Except the depositors are not retirees with savings accounts. They are sovereign nations, industrial giants, and the largest bank in America. And here is why this matters even if you have never bought an ounce of silver in your life. Silver is inside your phone. It is in the circuit board of your car and the solar panels on your neighbor's roof. When the price of silver explodes because a delivery system breaks, The cost of everything that contains silver follows it through the door. That is your electric bill. That is the price of the next laptop you buy. This is not just an investor story. This is a consumer story. Look at the math. The March 2026 futures contract alone carries exposure of 528 million ounces of silver. That is 105,000 contracts multiplied by 5,000 ounces each. The registered silver available to deliver against those contracts is roughly 103 million ounces. That is a ratio of more than 5 to 1. There are 5 ounces of paper promises for every single ounce of real metal that can actually be handed over. Now imagine a restaurant that sold 500 reservations for a dining room with 100 seats. As long as most people cancel or reschedule, the restaurant looks fine. But the moment 300 people show up on the same night, there is chaos. There are not enough tables. There is not enough food. The illusion of abundance collapses into the reality of scarcity. The COMEX is that restaurant, and the reservations are piling up while the kitchen is running out of ingredients. During the first week of January alone, COMEX warehouses experienced a withdrawal of 33.5 million ounces in just 7 days. That is 26% of the entire registered inventory vanishing in a single week. That metal did not move into the eligible category, which is silver stored in the vault but not designated for delivery. It left the vault entirely. It walked out the door. Someone took physical possession and is not bringing it back. This is not profit-taking. This is not routine portfolio rebalancing. This is a run on the vault. It is happening in slow motion, but the math is accelerating. Here is where JP Morgan enters the picture, and where the story turns from alarming to extraordinary. For over a decade, JP Morgan was the biggest silver short on the planet. They were betting that the price of silver would go down. They made billions suppressing the price through the futures market. In 2020, they paid a record $920 million fine for manipulating precious metals markets. That fine was not a denial. It was a confession with a price tag. But something changed. Starting in 2024 and accelerating through 2025, JP Morgan flipped. They went from the largest short to the largest long. They accumulated 750 million ounces of physical silver. They now control roughly 40% of all COMEX silver futures contracts. No single entity has ever held this kind of dominance over a major commodity market. Before 2025, the normal ceiling for any one player was 10 to 15%. Ask yourself a simple question. Why would the same bank that spent a decade pushing silver down suddenly spend billions buying it up? They did not have a change of heart. They read the math. They saw the supply crisis forming years before the rest of the market, and they positioned themselves on the right side of the trade before the door closed. JP Morgan's silver hoard is now valued at over $40 billion. That is not a rounding error. That is a strategic war chest. This is the same bank with an army of quantitative analysts, a direct line to the Federal Reserve, and more market intelligence than most governments. When they move $40 billion into a single commodity, they are front-running a structural shift that they can see coming because they helped build the system that is now breaking. And here is the kicker. Under the new Basel III banking regulations, gold has been reclassified as a Tier 1 asset, meaning banks can count it as 100% capital. Silver is following the same trajectory. If silver receives a similar upgrade, every major bank on Earth will need to hold physical silver on its balance sheet. That would create a stampede of institutional buying into a market that already cannot meet existing demand. JP Morgan is not just trading silver. They are front-running a regulatory shift. This is what the smart money does. They create the conditions and then profit from the reaction. While retail investors were watching price charts, JP Morgan was draining the vault. If this is clicking for you and you want the algorithm to show this to more people who need to hear it, hit that like button right now. One tap changes who sees this. This is information that could reshape how you think about your savings. Now let me explain why the supply side of silver just fell off a cliff. because JP Morgan is not the only force draining the vault. There are 3 other players ripping metal out of the system simultaneously. And when you see all 4 forces converging, you will understand why analysts are calling this a once-in-a-generation event. The first force is China. On January 1st, 2026, China implemented strict new export licensing requirements for refined silver. Only 44 companies received authorization to export silver for all of 2026 and 2027. China is the world's largest refiner of silver. They process roughly 60 to 70% of all refined silver traded globally. By restricting exports, Beijing effectively ring-fenced the majority of global refined silver supply for domestic use. This is not a trade negotiation tactic. This is resource warfare. China exported over 4,000 tons of silver in the first 11 months of 2025, while importing only 220 tons. They were a net exporter, feeding the Western market. That pipeline just got turned off. The West can no longer rely on Chinese silver to plug its structural deficits. Think about what happens when the largest supplier of a critical industrial material suddenly stops shipping. It is like Saudi Arabia turning off the oil taps. The price does not adjust politely, it ruptures. The second force is India. In October 2025, an order for 1,000 tons of silver placed by India triggered an immediate freeze in the London silver market. Silver lease rates, which are the cost to borrow physical silver, exploded from 0.25% to 200% overnight. Every trader in London withdrew from the market. One of the largest Swiss refiners announced they would not return until January 2026. The London market, the biggest physical silver market on Earth, seized up because of a single order from a single country. India is known to be significantly behind on its annual silver procurement. They are expected to demand thousands of additional tons before the year is out. And India is not alone. South Korea recently negotiated a $76 billion order of precious metals, including silver, directly with the Shanghai Gold Exchange. 2/5 of Shanghai's entire silver inventory vanished in 3 months. The BRICS nations are accelerating this drain. They watched the United States freeze $300 billion of Russian reserves overnight in 2022, and they took notes. Silver stored in a sovereign vault cannot be sanctioned, cannot be hacked, and cannot be devalued by a central banker pressing a button. That is why Eastern central banks are buying physical metal at a pace the Western exchanges were never designed to handle. The price differential tells the whole story. Shanghai physical silver has been trading at a $5 to $8 per ounce premium over Western benchmarks. That gap is a gravity well. It is pulling metal out of London and New York and shipping it east. Every ounce that leaves is one less ounce backing the paper promises on the COMEX. The arbitrage is literally draining the foundation out from under the exchange. The third force is the industrial vacuum. Silver is not just money. It is the most conductive metal on the periodic table. It is irreplaceable in solar panels, AI data centers, 5G infrastructure, electric vehicles, and solid-state batteries. Over 50% of all silver mined each year goes directly into industrial applications. It gets consumed. It gets soldered into circuit boards and embedded into solar cells. It does not come back. Stanford researchers recently demonstrated that a nanoscale silver coating solves the cracking problem in solid-state batteries, making surfaces 5 times more resistant to damage. Samsung is scaling this technology. Every major automaker is watching. If solid-state batteries go mainstream, silver demand from the battery sector alone could consume millions of additional ounces per year. And there is no substitute. There is no cheaper metal that conducts electricity as efficiently. There is no workaround. The modern economy runs on silver like the old economy ran on oil. For 5 consecutive years, the silver market has been in a structural deficit. Demand has outstripped supply by 100 to 250 million ounces annually. Mine supply sits at roughly 850 million ounces per year. The gap was being filled by drawing down above-ground stockpiles. But those stockpiles are not infinite. Registered silver inventories in Western vaults have plummeted by over 70% since 2020. The cushion is almost gone. Now put all four forces together. JP Morgan is accumulating at a historic pace. China has cut off exports. India is buying everything it can find, and industrial demand is accelerating into a supply that cannot keep up. The COMEX is caught in the middle of this collision with a vault that is draining faster than it can be refilled. This is the crisis nobody on mainstream financial television is explaining to you. They are showing you the spot price on a ticker and telling you silver had a good year. They are not telling you that the spot price is a fiction. It is a number derived from paper contracts that are backed by metal that may not actually exist in deliverable form. Here is the part that should keep you up at night. The registered inventory number on the COMEX is not what it appears to be. Registered silver includes metal that may already be allocated to other clients, pledged as collateral, or subject to competing claims. Think of it like checking your bank balance. The screen says $100,000, but $50,000 is earmarked for your mortgage. $20,000 is pledged on a business loan. Your real available cash is a fraction of the headline number. The COMEX works the same way. Nobody outside the vault operators knows how much metal is truly free and clear. That uncertainty is the fuse on this powder keg. March is the primary delivery month. Historical delivery rates in major months range from 10 to 20 million ounces. But January, a minor month, saw demand of 40 million ounces, 7 to 10 times the historical average. If March follows the same trajectory, delivery requests could reach 70 to 90 million ounces against a registered inventory that may already be spoken for. The math does not work. Something has to give. There are 3 scenarios for how this resolves. None of them are painless. Scenario 1 is a managed squeeze. The CME raises margin requirements aggressively, forcing leveraged traders to liquidate their positions. They did this in January when silver was approaching $120. 2 margin hikes in 48 hours. The price crashed from 121 to below 70. This shakes out the weak hands and buys the exchange more time. But it does not fix the underlying supply deficit. It just delays the reckoning and makes the eventual move more violent. Scenario 2 is forced cash settlement. If physical delivery requests exceed available metal, the COMEX could settle contracts in cash instead of silver. The London Metal Exchange did exactly this with nickel in 2022. They canceled trades and forced cash settlement when prices spiked out of control. If this happens with silver, it would destroy confidence in the paper pricing system overnight. It would create 2 markets, a paper price you see on a screen and a physical price you pay at a dealer. Those 2 numbers could diverge by 30, 50, even 80%. Scenario 3 is the one that changes everything. A genuine delivery failure. The COMEX cannot fulfill its obligations. Buyers who stood for delivery are told there is no metal. This has never happened in the modern era for silver, but the conditions have never been this extreme either. If it happens, the price does not just spike. It reprices the entire concept of what silver is worth. Analysts who model this scenario project prices between $150 and $300 per ounce, as physical scarcity drives panic buying across every market on Earth. JP Morgan has positioned itself for all 3 scenarios. If the squeeze happens, they profit from their massive long position. If cash settlement occurs, they already hold the physical metal that becomes the only real asset in a market of broken promises. If delivery failure hits, they are sitting on 750 million ounces of the most sought-after industrial and monetary metal on the planet. Now think about what each scenario means for you personally. If you hold paper silver, whether that is futures contracts, leveraged ETF products, or shares in a trust that does not actually allocate your metal, you are exposed to the same risk that killed traders in the London nickel crisis. The exchange can change the rules in the middle of the game. They can raise margins to force you out. They can settle your contract in cash at a price they determine. You are playing in someone else's casino, and the house always protects itself first. If you hold physical silver, None of that applies. Your metal does not depend on a counterparty keeping a promise. It is yours, period. They paid a $920 million fine for manipulating silver downward for a decade. That fine was the cost of accumulating their position at artificially low prices. They suppressed the price, loaded the truck, and are now waiting for the market to discover what they already know. The paper game is ending, and the wealth transfer is already in motion. It is moving from the people who hold paper promises to the people who hold physical reality. So what do? How do you position yourself when the largest bank in America is telling you through its actions that physical silver is the trade of the decade? First, you need to understand the trap you might already be sitting in. If you own shares of SLV, the largest silver ETF, you own a claim on silver held in a vault managed by JP Morgan. The referee and the biggest player are the same person. If the system cracks, your ETF shares could be settled in cash while JP Morgan keeps the metal. You would be paid in the very currency that the crisis is devaluing. That is not protection. That is a trap with a bow on it. Funds like Sprott Physical Silver Trust buy allocated physical silver stored in the Royal Canadian Mint. Sprott just doubled their capital raise program to $2 billion specifically to acquire more physical metal. When institutional money is racing to secure silver at this pace, pay attention to the direction of the stampede. Second, if you are buying physical silver yourself, understand that the premium above spot price is the only honest price signal left. When the premium at your local dealer is 30 or 40% above the COMEX spot price, the paper price is lying to you. The dealer premium is the truth. Those premiums have been expanding for months. They are the market screaming what the futures exchange refuses to admit. Third, look at silver miners the way a business owner would. When the price of silver doubles, a mining company's profit can increase 5 or 10 times because extraction costs stay relatively fixed. But not every miner survives a crisis. Look for proven reserves, low debt, and strong cash flow. Fourth, and this is what separates people who preserve wealth from people who lose it, stop thinking about silver as an investment and start thinking about it as insurance. JP Morgan is not holding 750 million ounces because they think silver is a fun trade. They are insuring themselves against the collapse of the system they built. Central banks are not buying gold and silver because they like shiny objects. They are buying it because they do not trust the paper anymore. If the institutions that run the financial system are hedging against its failure, why are you still 100% invested inside it? The COMEX was built on a simple bet, that nobody would ever call the bluff, that the paper promises would always be enough because most people would never demand the real thing. For 50 years that bet paid off, but the world has changed. Nations are hoarding resources, supply chains are fracturing, industrial demand is exploding, and the largest financial institution in America just took delivery of silver that the vault barely had to give. The London Gold Pool controlled the price of gold for decades. Then it broke in 1968, and gold went from $35 to $850 in 12 years. Every system built on paper promises eventually meets the limits of physical reality. The COMEX is approaching that limit right now. JP Morgan did not accumulate 750 million ounces because they think the system is fine. They accumulated it because they know it is not. They built the paper game. They know where the cracks are, and they have positioned themselves on the winning side of the break. The question is, which side are you on? The window is still open, but every week that passes, the vault gets lighter. Every delivery notice drains another few million ounces from a system that is already gasping for air. When the headlines finally catch up to the math, the premiums will explode, the dealers will run dry, and the only people who got in at rational prices will be the ones who moved before the crowd. But knowing that silver is in crisis is only half the picture. There is a specific week in March where delivery notices will pile up against a vault that may not have enough metal to honor them. If that week passes without incident, the system bought itself another few months. But if the delivery requests exceed what the vault can produce, we witness something that has not happened in the modern era: a failure of the most important commodity exchange on Earth. I identified the exact date window, the 3 warning signals that will flash red before it breaks, and the one move JP Morgan is making right now that tells you which scenario they expect. Click this video right here. What I found in the CME delivery data will change how you think about every ounce of silver on the planet. I will see you there.